Hi everyone, I'm Alex and welcome back to Market Brief, where we help you stay informed and make smarter investing decisions. Today's topic is a big one: inflation and how it impacts your investments, not just today, but over the next decade. Let's face it, inflation is everywhere. From rising grocery prices to increased housing costs, it's hitting all of us. But when it comes to investing, inflation can either erode your wealth or offer hidden opportunities, depending on how you play it. Stick around, because by the end of this video, you'll know how inflation affects different asset classes, which sectors and strategies thrive in an inflationary environment, and actionable tips to safeguard and even grow your investments. Quick reminder, I'm not a financial advisor, and this isn't official financial advice. It's all about providing insights so you can make informed decisions. Let's get into it. 1. What is inflation and why does it matter? Before we dive into strategies, let's quickly define inflation. Inflation is the rate at which prices for goods and services increase over time. Essentially, it's what happens when your dollar doesn't stretch as far as it used to. For example, in 2000, a gallon of milk cost around $2.50. Today, it's closer to $4. That's inflation in action. Why does this matter for investors? Because inflation eats away at your purchasing power. If your investments aren't growing faster than inflation, you're effectively losing money over time. For context, the U.S. Federal Reserve aims for an annual inflation rate of around 2%, but in recent years we've seen spikes well above that. High inflation doesn't just affect consumers, it shakes up financial markets too. Stocks, bonds, real estate, and even cash all react differently to inflation. 2. How inflation affects different investments. Let's break down how inflation impacts major asset classes. Stocks. Stocks are often considered a hedge against inflation because companies can raise prices to match rising costs. However, not all stocks perform equally. Growth stocks, like tech companies, tend to suffer in high inflation environments because their future earnings are less valuable when adjusted for inflation. On the flip side, value stocks, companies with strong cash flow and pricing power, often do better. Bonds. Inflation is a bond investor's worst enemy. Why? Because the fixed interest payments on bonds lose value as inflation rises. TIPS, Treasury inflation-protected securities, are an exception. They're designed to adjust for inflation and can be a smart option during inflationary periods. Real estate. Real estate is a classic inflation hedge. Why? Because property values and rents often rise with inflation. However, rising interest rates, often a response to inflation, can make borrowing more expensive, which might slow down real estate growth. Commodities. Commodities like gold, oil, and agricultural products tend to thrive during inflation. Gold, in particular, is often seen as a store of value when currency values are eroding. Cash. Cash is the worst place to be during inflation. Why? Because it loses purchasing power over time. A dollar today buys less tomorrow. 3. Sectors and strategies that thrive in inflation. Now let's talk about where to invest during inflationary periods. Energy and commodities. Rising oil and natural gas prices often mean big profits for energy companies. Commodities like agricultural products and metals also tend to perform well. Consumer staples. Think companies that produce essential goods, food, beverages, household items. These businesses can pass on higher costs to consumers, maintaining their profit margins. Healthcare. People need healthcare regardless of economic conditions, making this a relatively safe sector during inflation. Real estate investment trusts, REITs. REITs are a great way to invest in real estate without owning physical property. They often perform well in inflationary environments, especially those tied to residential and commercial properties. Dividend stocks. Companies with a history of paying and growing dividends can provide steady income that offsets inflation's impact. 4. Actionable tips to prepare for the next decade. Now that we know how inflation affects investments, here are 4 actionable tips to prepare for the next decade. Diversify across asset classes. A mix of stocks, bonds, real estate, and commodities can help you weather inflation's ups and downs. focus on pricing power. Look for companies in sectors like consumer staples and healthcare that can easily pass on rising costs to consumers. Invest in inflation-protected assets. Consider TIPS, RATs, and commodity ETFs as part of your portfolio. Avoid excessive cash holdings. Keep enough cash for emergencies, but don't let large amounts sit idle. Invest in assets that grow over time. 5. Long-term perspective. Finally, let's zoom out. Inflation isn't going away. It's a natural part of the economic cycle. The key is preparation and patience. By diversifying your portfolio and focusing on assets that thrive during inflation, you can protect your wealth and even find opportunities to grow it. Remember, the goal isn't to beat inflation in a single year. It's to stay ahead over the long term. Thanks for tuning into Market Brief. If you found this video helpful, make sure to like, subscribe, and hit the notification bell so you never miss our latest insights. What's your go-to strategy for beating inflation? Let me know in the comments. I'd love to hear your thoughts. Until next time, stay informed and invest wisely.